Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. Fidelity Canada offers a range of Canadian, US, and global ETFs in different asset classes. Whether it's active, factor-based, fixed income, sustainable investments, or digital assets, Fidelity offers a mix of ETFs for various investment styles or time horizons. Joining the show today to talk us through his best ideas with Fidelity ETFs and for a look at the latest ETF industry trends is Fidelity ETF strategist Raghav Mehta. Raghav delves into the concept of using factor-based models in ETF selection, citing Fidelity's systematic Canadian bond ETF as an example of how quantitative analysis can optimize bond portfolios for risk-adjusted returns. He also emphasizes the importance of seasonality in investment decisions and how historical patterns can guide current strategies. As an example, he highlights the potential benefits of Canadian bonds with extended durations following rate cuts, pointing out their historical outperformance in such periods. He also discusses Fidelity's all-in-one ETFs as comprehensive solutions for diversified portfolios, being designed to navigate various market conditions efficiently, and explains his team's strategic approach to their ETF offerings, blending historical analysis with quantitative methods to address investor needs across different asset classes and market environments. This podcast was recorded on June 28th, 2024.
Let's talk a little bit about what we just said there, the timing. Here we are at the very end of the first half of this year. Where does seasonality come into pretty much everything you're doing right now?
So, when we talk about seasonality, we talk about market timing. We want to go back in time and identify trends and themes. So what I'll do today is we'll discuss where the market's headed based on historical patterns and pick the best four ideas from an investor standpoint, from an advisor standpoint. We'll touch upon how can we play these trade ideas with our lineup of ETFs. And then we can get into why choose this ETF, why this idea, why it makes sense, and we go from there.
Perfect. So at this time of year, seasonal, we're seeing, for instance, economic data come in, and they have to be adjusted for seasonality. Why does the ETF lens have to be adjusted for seasonality as well?
Yeah, perfect. So we need to make some adjustments when you look at the whole macro movement, right? The first idea that comes to my mind is using Canadian bonds and extending duration. So again, if I go back in time and I look at seasonality and market timing, when I say seasonality, it's not sell in May and go away.
No, that's good. It's good to say that, yeah.
Exactly. It's basically seasonal rotation. So one idea that I want to pitch is Canadian bonds and extending duration. Why? So we went back in time, we studied bonds, how they performed since the 1970s. We noticed that it's actually the bonds that rally in the 18 to 24 months after the last rate hike. After the rate hiking cycle is over, the 2 years, that's when the bonds rally. In fact, in Canada, it's not just the hikes. Now we've already witnessed the first rate cut. Canada happens to be the first of the G7 to have witnessed the first rate cut. That's when the duration or the long-term bonds benefit the most in a declining rate environment. So it's not just that. If I again bring up seasonality and I go back in time and I study how bonds have performed, the 6 to 12 months after every rate cut, that's when longer-term bonds outperform their shorter-term counterparts, including outperforming stuff like the cash-like products, GICs, money markets, HISA, because the reality is that cash won't pay 5% forever, right? So you want to rotate, and what duration does is it not only gives you a chance to clip coupons as you go along the way, but also get that significant upside when bonds rally and rates get cut. I want to talk about valuations. You look at bond prices. It took us 18 years to get to this point. That's telling me as a trader
bullish, yeah,
that it's a screaming buy, right? Yeah. And I can perhaps get into how we can take advantage on this.
Absolutely. Can I just ask what the cut and then a higher inflation than we thought does to the whole timing?
Yeah, perfect. So a wrong inflation print in the wrong direction. Inflation ticked up in Canada this week. That was primarily driven by grocery prices and rents. But the story is one bad inflation print does not make or break the situation. It does not bring rate cuts off the table because the reality is that Bank of Canada and the Fed, they still have a 2% target that they want to attain sooner or later. So what this might do is it might be a slower and gradual process. over time when it comes to the rate cuts and getting there at the 2% mark. And the path to that end goal might be bumpy, it might be choppy. So what might happen is it might lower the probability of the July rate cuts. And the rate cuts might get pushed to a later part of the year, which might be September. Kind of might coincide with the Fed's timing of the rate cuts in the US. But what this does is, on the contrary to the advisors, it's kind of expanding the window of opportunity to get in, lock in the higher yields that you're seeing, and also lock in the lower valuations that I showed on the screen there. What if inflation ticked down and cooled off and the rate cuts happen too fast, too soon? All that window of opportunity will be gone in a flash.
So you can kind of get in there, clip the coupons at a higher rate for a little while.
Exactly.
As the pace of cuts maybe is slowed. We don't know for sure.
Precisely.
But it's a little bit of a second crack at it.
Exactly. It's giving you time. It's giving us time to reallocate the portfolios, get out of the cash-like stuff, get into duration, get into bonds, and we can use ETFs for that idea.
Fantastic. The piece that you also wanted to mention about bonds, just getting back in there, sort of the valuation, and I mean, this is quite fascinating in an ETF world, how this works and how you put it all together.
Yep. So one idea that I want to bring up is using the systematic Canadian bond ETF. So it's a really unique product. It's a one-of-its-kind approach. And why is it that way? It's basically our mathematical geniuses, our statistical wizards from MIT and Harvard out of our Boston office. We call them quants. Some people call them financial engineers.
And rocket science.
Exactly, rocket scientists, right? So they use a proprietary factor-based model to handpick the best, highest quality bonds that could choose for their portfolio. So how did they do that? They use mathematical rules. So we use math, science, and statistics to analyze bonds and pick the best ones that have the most efficient risk-adjusted returns, the highest Sharpe ratio. And for example, so if you break down the Canadian bond market universe by issuers, by maturities, by credit ratings, we go back in time. The quants go back in time. They look at the 10-year track record of risk and returns, the numbers over those 10 years. And they end up picking the ones that have the highest and the most efficient Sharpe ratio.
Right.
So that's what the bonds, that's the bonds that we are overweight. And we end up, through the natural selection process, going underweight or eliminating a lot of the inefficient ones that have a lower Sharpe ratio. So what ends up happening is, if you go back in time, we found out that it's the 1 to 5 year maturity, the shorter term corporate bonds with a BBB and a AA rating that have had the highest track record in terms of Sharpe ratio. So that's what we're overweight overall in the portfolio, and we end up getting a barbell. And I can perhaps touch upon what a barbell is. So if this is the yield curve, we end up overweighting the same bonds that I was talking about, the 1 to 5 year shorter term credit on the front end of the curve.
Yeah.
And then because we're taking on credit risk on the front end of the curve, we kind of want to offset or balance that by taking duration risk or buying some government bonds on the far end or the longer end of the curve. And what we get is a barbell. So
it's not, you're not investing, I mean, broadly in the belly of the curve. This is actually, it's the opposite.
It's not, well, I would kind of see that as a scattered belly. So we are somewhat on the 1 to 5 year. So it's the 5 year point where the belly begins. It's kind of scattered across the 1 and the 7 year mark on the front end. And then you have the longer term treasuries on the long end of the curve. What that does is it minimizes portfolio volatility and downside risk versus the broad bond market. And it also gives you a better bang for your buck from a rate cutting cycle perspective.
Fantastic. Okay, let's move on to, so that's the bond side of things. This ETF is fascinating, and there's more to go in there, but I do want to make sure we move on to the equity piece of it that you've been looking at and that you're going to bring to us. This is a small cap story, which we think with a rate cut should really have wind in its sails. Is that sort of the catalyst story for small caps?
Yeah, for sure. So, I meet with advisors across the country. My job is to sit down with them and look at what they're holding in their portfolios. And one thing that I noticed is that everybody is holding the mega cap, the FANGs, and your tech stocks like NVIDIA, the top 7, the top 10 names. But the problem there is, I mean, don't get me wrong, these are great names to own. These are great stocks to hold up in the long run. There's nothing wrong with them. But what that does is it adds concentration risk, because the reality is the top 10, the top 7 names actually contribute to 65% of the market cap in the S&P 500 or higher. And when the whole world is buying these tech stocks, they get expensive, right? So we have concentration risk and also valuation risk. A thoughtful way to kind of counter this with a differentiated solution that not only offers diversification, for lack of a better word, is small caps. They're trading at a huge discount relative to large caps. It's never been this cheap, historically speaking, in the last 20 years. And it's trading, the valuation is trading over 30% below the long-term average. So it's never been cheap relative to large cap, but also the last time this happened over a 50-year period was back in the dot-com bubble.
Right. Okay.
Number two, if you also look at the multiple of small caps, it's also cheap relative to its own history, not just relative to large cap or the other parts of the market. And we all know that small caps happen to outperform the large caps over a 35-year period. And then again, I want to bring up the concept of seasonality, seasonal rotation. So we went back in time. Fidelity loves studying trends and patterns. We went back in time. We looked at how did small caps fare after a rate cut. So history tells us that it's the 6 to 12 month period when small caps rally after a rate cut with the highest probability, 83% probability, and the highest hit rate. So again, if you use history as a guide, history tells us that it's the rate cut when the market rallies, and it's going to be the small cap that's going to be the fastest moving segment in the equities market.
So interesting. Okay, so anything else on small cap? Because that actually sounds like, in a way, its own barbell, like the discussion of bonds ultimately and what they do in the sort of 6 months after the rate cuts begin, or we've peaked on hikes, and then small caps, which also should sort of catch that. That's really interesting strategy to look at overall. The all-in-one ETFs, I mean, they would capture all of that plus a little more. Talk to us about the all-in-one, how that fits.
Sure.
Again, in terms of timing.
Yep, and before I lose my thought on the small caps, we have an amazing fund. It's the Global Small Cap Opportunity Fund. The ticker is FCGS. It's a high conviction portfolio, 40 to 80 names, 90% active share, invested in quality names with a value tilt, looking for mispriced companies that have a positive catalyst for change. And we have 97 to 98% peers beaten. Now, if you don't want to buy this product or fund in the small cap space directly, we have the 60-40 portfolio. We have the all-in-ones. And again, for the all-in-ones, sorry to
by all means,
I guess digress.
Bring it in. Yeah.
But to talk more about the 60-40, so again, I'm going to use the concept of seasonality and market timing.
Okay.
We went back in time. We studied how different asset classes behaved and how they performed. You look at US equities, Canadian equities, international equities, fixed income bonds, GICs, and so on and so forth. And we look at how they perform in the 18 to 24 months after the last rate hike, going back in time over last 5 rate hiking cycles. So we take an average of the performance in the 2 years or the 18 to 24 months after the last rate hike. Turns out it's the 60-40 portfolio. It's the balanced portfolio that happens to be one of the best performing strategies, most stable strategies with the highest hit rate, outperforming other asset classes on average. Now, when I say balanced, it does not have to be 60-40. It could be 40-60, 80-20, so on and so forth. But what advisors want nowadays is they are looking for this single turnkey, one-ticket solution. One single transaction gets them access to a globally diversified portfolio, diversified across sectors, across geographies, strategically designed, that's automatically rebalanced. So then we came up with the all-in-ones. We have this best-selling lineup. That's the all-in-one. So they come in 4 editions, from the most conservative to the most aggressive: 60-40, 40-60, 85-15, and 97% equities. That's the most aggressive one. And again, what these portfolios are is they hold Fidelity's very own equity factor ETFs and the bond ETFs along with small cap, and you sprinkle a bit of the Bitcoin ETF. We rebalance it for you. It's hands-off, low touch from the advisor's perspective. And then again, more and more advisors are looking for this all-weather portfolio that will stand the test of time. Now, the good thing about this lineup is we don't charge any direct management fee. All you pay for is the weighted average of the ETFs held in the funds. So again, we don't have any extra layers of any additional fees or any hidden fees. We don't want to double dip the advisor or the client. We don't want to charge the same advisor or the client twice, unlike our competitors who might be charging, let's say, a 20, 30 beeps of a rebalancing fee. This all comes for free. It's the fastest selling and the fastest growing market in the ETF industry in Canada. I look at it as the cost conversion. So cheaper does not mean inferior. So it's
I love that.
lowering the cost. It's roughly half the price of your traditional balance mutual
Long
fund.
lineups at the gas, though, I gotta say.
Yeah,
Long
exactly.
lineups.
But everyone's paying.
But everyone does it.
Yeah, everybody's paying to get in.
That's right.
And buy that cheaper good for good quality.
No, it's fantastic. And it's a great description. Thank you for that. So this circles back to bonds where we began. I believe bonds are in a bear market. There's a narrative for that, unless we have a hard landing. Your thoughts?
Yeah, perfect. So that's a good, I guess, objection. When you look at the hard landing narrative, in fact, fixed income as a defensive asset class actually holds up well. It does well as an asset class when things are getting slower, and we are getting that hard landing risk, especially in Canada. But then again, that's when you want to be embracing duration. When rates get cut faster in a hard landing scenario, and if you see that risk, you want to capitalize on that trade by embracing duration, buying longer term bonds that actually outperform in this market environment. But then it all makes sense to buy higher quality bonds. So that's what this ETF, the Systematic Canadian Bond ETF. So that's what this ETF does. It gives you access to the highest quality bonds with the highest Sharpe ratio. As I've explained earlier, one single transaction gets you access to 900 bonds of the highest caliber, highest quality. Now the bond market trades over the counter. It's an opaque market. It's hard for the advisors to buy and sell and trade bonds yourself. So what this ETF does is one single trade gives you access to 900 bonds of the highest quality. And this ETF, the ETF structure is tradable. It's more liquid. So it gives you the ability to get in and out. In fact, it's more liquid than the bonds, the underlying bonds themselves held in the portfolio.
Oh, that's interesting. It's more liquid.
Yep, exactly. It's one of the most liquid ETFs that we've got. So again, if you want to also kind of time it or do a swing trade or rotate every few quarters, it just makes more sense to use ETFs as opposed to trading bonds yourselves, because advisors might get an inferior price when they're trying to fill the trade or fill the order. And yeah, 25 beeps MER.
So, okay, good. With the rebalancing, I mean, you think of this as, what sort of horizon are you thinking about? You're thinking about?
I would look at, at least next 8 to 12 months if I want to expect a rally, or, even longer, right? Bonds is always something that advisors should consider for retiring clients, because you not only get the upside when rates get cut, which is the environment that we're in, but you also clip coupon on a monthly income basis. So it's got 3 to 4% distribution yield on average. And in fact, if I stack up where we stand versus our competitors, we've got one of the highest monthly distribution yields as a percentage of the NAVs. And again, cash would not pay 5% forever. So you want to be reallocating to bonds in this kind of a market environment.
Have you noticed those flows that's happening?
Yes. In fact, 2023, last year in Canada, fixed income was one of the best asset classes where all the flows went into, if you look at the Canadian ETFs. And again, this month as well, in June, both in the US and Canada, we have seen significant flows in duration. A lot of the money that was parked on the sidelines in GICs is now slowly moving out and getting into bonds, be it either long-term bonds or even mid-term bonds.
Right. Okay. Fascinating. Now, Sustainable World is a fund that we've spoken about actually through the pandemic. I remember it holding up incredibly well. There was sort of this stickiness with investors. I haven't spoken to anyone about it recently. Give us a bit of a sense of how it's doing, and just remind us a bit about this fund.
Yeah, for sure. So this idea of sustainable investing is less of a seasonal trend, but more of a secular, longer-term theme. As the saying goes, doing good does good for your money, or if you believe in karma, like a lot of people do, if you do good things happen to you. If you invest in companies that are socially responsible, environmentally conscious, environmentally friendly, and businesses that operate with integrity, they've actually outperformed the large cap universe of stocks over the long run. In fact, if I go back in time and you design a portfolio by you're not a stock picker, you simply pick the most sustainable stocks, they actually have better risk-adjusted returns versus a portfolio that completely dismisses the concept of sustainability. And even if it's a stock picking portfolio that's picking the best fundamentally attractive stocks. And furthermore, if we go back in time and I look at, again, seasonality and market timing, whenever we've had these events of financial stress or extreme market events like a large sell-off, a black swan event.
Over what period of, going back into, since the fund began, or even?
We went back into the 80s. We look at some events like
Okay.
the 07, 09 subprime credit crisis. You look at the 2011 debt ceiling. We look at one of the flash crashes that happened. We noticed that it's the ESG stocks, it's the sustainable stocks that actually outperform your non-sustainable stocks or companies with a lower ESG score, and they hold up and weather the storm a lot better than their counterparts or the other peers that are not in that sustainability team.
Right.
We've got an ETF that you can use this to take advantage. In fact, in 2023, sustainable stocks actually outperformed all major sectors last year in 2023, if you look at equities.
So what's sustainable mean? I mean, it means responsible for sure.
Mhm.
What's in there? Like, you don't give us names, but
Sure.
sort of describe to us what you're looking for. Exactly.
Yep, so we basically have a crystal clear filter. We exclude sectors like alcohol, tobacco, gambling, arms and ammunition warfares. On the environmental side, we look at avoiding oil and gas exploration stocks. We avoid coal power plants, coal power generation. Gambling would be,
Right.
lottery would be another one. So right now, if you look at the portfolio, and I can use the Fidelity Sustainable World ETF as an example, the ticker is FCSW. So this portfolio is holding most of, obviously, the tech stocks, the AI enablers, NVIDIA. And then if you look at sectors, we are overweight technology stocks, as I said earlier, and also financials. And this ETF kind of marries the two worlds. So on one hand, if you're a sustainable investor, you want to design a portfolio by picking the most sustainable stocks. And on the other hand, you're a stock picker. Regardless of the ESG concept, you want to pick the most fundamentally attractive stocks. This kind of marries the two extremes. And you start off with shortlisting the most sustainable stocks in a subset, stocks with the highest ESG score. And then step two is you use a quantitative process. This fund is actively managed. We're using a quantitative process to look at the best fundamentally compelling companies from that subset that uses a factor-based approach. So we're using a factor model along with active management to pick companies that are higher quality in nature with growth characteristics, momentum, trading at reasonable valuations and profitability using a multi-factor quantitative process in this portfolio.
Is it low vol as well?
The risk rating is medium.
We're back to bonds.
Perfect.
How does the Canadian, you're a bond guy, so this is
Yes.
kind of your wheelhouse.
Yeah.
This is fantastic. Okay.
Yeah.
How does the Canadian systematic bond ETF stack up against the multi-sector bond ETF? So you're telling us Sustainable World and some of the competitors there. Let's look at these two bonds, which are both Fidelity.
Yep. So a multi-sector bond is more of a global mandate. It's an actively managed tactical strategy run by Jeff and Mike, and they invest in a combination of high yield and investment grade bonds across the globe. Whereas the systematic Canadian bond is more like a smart beta approach to investing. So we have Bobby Barnes that comes every now and then on Fidelity Connect to talk about factors, talk about quantitative ways of investing. This product, the systematic bond ETF, is like looking at investing into the world of bonds through a quantitative lens, an equity style of investing.
Okay, that was just like an equity quant style.
Exactly.
But for bonds.
Exactly. So it's a lower cost. And the other difference is this is purely Canadian. So it invests in 100%, almost 100% investment grade bonds, domestic in Canada. It's kind of like your made in Canada approach to investing using a quantitative process. If you talk about fee and the way the portfolios are run, this is more of a smart beta approach, which is why the fee is a little lower, 25 beeps. But that does not undermine active management either, right? So with the multi-sector, you're investing in leveraged loans, CLOs, you're investing in high yield, you're investing across the globe and finding the best fundamentally compelling bonds that have higher double-digit yields, for example. So again, that's a different way of investing. And it's more of a core building block, the multi-sector, whereas this one is more of a Canadian theme, a play on Canadian bonds given the current rate environment. They're both great products to hold over the long run.
Are Canadian bonds attractive right now?
I
think you're going to say yes.
Yeah, my short answer is yes.
Yeah,
and
why?
I think for the same reasons, right? So in the US, we are still in a higher for longer narrative. Inflation is slowly starting to see disinflation in terms of its own trend, but the whole rate cutting cycle is kind of delayed. Whereas if you just compare Canadian bonds versus US bonds, actually, if you look at the credit spreads and the yields, the level of the yields that you get on holding a corporate bond in Canada of the same shape and size versus its counterpart in the US, you actually get a better yield holding Canadian bonds. And bonds, being a defensive asset class, actually do well when the economy is weakening. That's the theme overall in Canada, whereas in the US, you still have that softer landing narrative where we are soon to avoid a recession altogether. So I think it makes the case for holding Canadian bonds because things look a little weaker here in Canada, fundamentally speaking, and that's when bonds tend to perform as a nice cushion against your equities portfolio for the advisors.
Fascinating. So interesting to hear your thoughts. Do you have sort of a final thought just to wrap up some of the pieces that you've given to investors here today?
Yep. I think I want to talk about the Fidelity advantage. So why or what makes Fidelity ETFs a lot different versus our competitors? So if you go on Google, go online, you search or Google Fidelity investments, you look up Fidelity and you might pop up Wikipedia and you start reading about Fidelity. The number one things that would pop up you would see would be Peter Lynch and the Magellan funds, right? So Peter Lynch has been the best performing portfolio manager in the history of mankind, history of time, right? And that's what's symbolic of Fidelity. So it's the research, it's the alpha generation that makes Fidelity different. That's what identifies with Fidelity. So when we came about launching ETFs in Canada back in 2018, we did not want to compete with the passive index providers, the BlackRocks or the Vanguards, because that market is already mature, it's already saturated. We wanted to see if we could offer that same research, the same top-notch research. Fidelity is known to be a stock picker. Can we offer that same research to help generate alpha and give access to that same research in a more cost-effective manner at a lower cost and kind of like democratize investing in a more low-cost way? So we came about launching factors using our quants, which are a lot more cost-effective. And then we took our best-performing, actively managed mutual funds, and we launched ETF series of those funds to give advisors flexibility. And again, my parting words would be, I was talking to one of the quants. As the saying goes, we are not an equities or a bond shop. We are not a quant shop. We're not a fundamental shop. We are an alpha shop that is known to generate that research, and we invest heavily in our research capabilities. We want to give that same access with our ETFs at a lower cost.
Fantastic. Raghav Mehta, thank you for joining us in person here. It's been a great message to share with everyone. Have a good long weekend.
Thanks for having me. Thank you. You too.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.